banking industry is undergoing a dramatic shift driven by heightened competition from fintechs, evolving business models, expanding regulations, compliance requirements, and disruptive technology. Regulations and compliance requirements are becoming more stringent as the frequency of data breaches and privacy concerns continue to rise. And if that weren't enough, changing consumer needs include a need for personalized service available around the clock. So speaking of personalized needs, I came across an article that said, when it comes to handling money with a friend, family member, or partner, things can get rocky pretty quickly, especially when a disagreement reveals that you have very different ideas of what's fair. And so members of the BuzzFeed community were asked to share their stories of times when money ruined a relationship, and their responses were absolutely unbelievable. One story that stood out in particular to me was this one. It said, "And finally, the entire maternal side of my family is divided and destroyed because of money. We used to be super close and loving. Then my maternal grandparents died within 6 years of each other and right before Christmas. So trouble began when my mom and her 3 siblings began cleaning out their childhood home to be sold. The whole time, one aunt asked again and again when she was going to get her inheritance, and no one had an answer fast enough for her liking. This led to her bad-mouthing all of them to anyone who would listen about how everyone was keeping money from her. She didn't come to family events for the next 8 years, and there are still some family members who won't speak to us and have blocked us on social media. She said that basically my entire family situation has been a mess since because of the chain of events that began with my grandparents' deaths." Man, can you believe that? I know I actually can because I have experienced a similar situation myself, unfortunately. Needless to say, it didn't really end too well. So how about you? What do you think? With the economy in an uproar and inflation on the rise, money continuously getting tighter for some, are you experiencing any conflicts with the personalized needs of your friends, family, or even partners, boyfriend, girlfriend, or husband or wife? And I mean, I can't even begin to think about how complex and complicatedly tricky money situations can be today with lots of folks engaging in polyamorous relationships. I mean, how does that even work? I guess you just get one big, giant, mega joint bank account at the bank, I guess. Maybe not, since the banks apparently don't need the workforce they once had, as staff at Wells Fargo Mortgage prepare for layoffs due to the decline in U.S. loan volume. According to persons familiar with the company's financial information, the bank had about 18,000 loans in its retail origination pipeline in the first few weeks of the fourth quarter. So according to the person who asked for anonymity since the conversation was about internal issues, that's down as much as 90% from a year ago when the housing boom powered by the COVID epidemic was in full force. The housing market in the United States has had ups and downs recently, exploding in 2020 due to easy money policies and the adoption of remote work, and slowing down this year due to the Federal Reserve raising interest rates. As borrowing costs increased to above 7% for a 30-year loan from just under 3% a year ago, home buyers were put under pressure and the refinancing rate plunged. And given that the Fed is anticipated to raise its benchmark rate once more, rates may rise even further. The industry from home loans has felt the pinch, especially companies like Rocket Mortgage. I mean, it was built on loan refinancings and is predicted to bring about consolidation among the more recent non-bank operators. They hurried to serve customers when most U.S. banks left the sector. And in the past, Wells Fargo has been the most dependent on mortgages amongst the 6 largest U.S. banks. But under CEO Charlie Scharf, who has stated that the bank is trying to reduce the business and focus primarily on serving current customers, things have started to shift. Early warnings from the banks, which informed investors in October that the housing market would slow down even further after reporting that mortgage originations dropped by almost 60% in the third quarter. And CFO Mike Santomassimo stated to an analyst on October 14th that we anticipate it to continue to be hard. Mortgage banking income will probably continue to drop in the fourth quarter because originations will be seasonally lower than ever. The bank stated that the bank started laying off employees in April, and internal predictions indicate that there may be more departures, putting employees further on edge. When Wells Fargo offices were obligated to notify municipalities of imminent job losses, local news sources covered the story. And according to one of the sources, the number of mortgage loan officers who primarily receive commissions from closing deals will decline from more than 4,000 at the beginning of the year to under 2,000. And according to this person, many salespeople haven't completed a single loan in recent weeks. Another claimed that most departures were voluntary as bankers look for alternative employment options, making forecasting leads and staffing levels challenging. So according to a Wells Fargo spokesman, the modifications we've recently made are the outcome of the broader rate environment and consistent with the response of other lenders in the sector. And we analyze and adjust staffing levels frequently to reflect changes in the market and our company's needs. So the bank announced that last month that its entire employee count dropped by almost 14,000 people in the third quarter. That's roughly 6%, down to a little over 239,000 workers. Since the start of the year, shares of Wells Fargo have decreased by about 2% in the stock market. The banking industry's issues can be solved using the same technology that caused this disruption. However, the transition from outdated to cutting-edge techniques hasn't always been straightforward. Therefore, banks and credit unions must accept digital change if they hope to flourish in the current market. That current market seeing 1, an increase in competition. Fintechs pose a severe danger since they frequently target some of the most lucrative financial services and industry sectors. According to Goldman Sachs, these firms will drain upwards of $4.7 trillion in yearly income from established financial services and corporations. Many financial institutions are being forced as a stopgap solution by these new market entrants to look for partnerships and acquisition prospects. For instance, Goldman Sachs recently made news for aggressively investing in fintech. Traditional banks and credit unions need to learn from the fintechs to keep up with the competition, as they are successful because they offer a straightforward and user-friendly client experience. Number 2, culture shift. Technology has been ingrained in our culture, extending to the banking sector. Technology has become pervasive, from wearables with artificial intelligence, AI, that track the wearer's health, to smart thermostats to let you change heating settings from internet-connected devices. Manual procedures and processes have no place in the digital era. And to address the banking industry's issues, banks and credit unions must consider technological solutions. Financial institutions must foster an innovative culture using technology to enhance current processes and procedures for optimal effectiveness. This culture shift towards a technology-first mindset reflects the general industrial adoption of digital transformation. Number 3 on the list includes regulatory compliance as a direct result of the enormous increase in regulatory costs related to earnings and credit losses since the 2008 financial crisis. Regulatory compliance has become one of the banking industry's most significant difficulties, with Basel's risk-weighted capital requirements, the Dodd-Frank Act, the Financial Account Standards Board's current expected credit loss, and the allowance for loan and lease losses. Banks and credit unions are subject to a growing number of restrictions. Compliance can place a significant burden on resources and is frequently reliant on the capacity to correlate data from different sources. Number 4, modifications to business models, which financial institutions are being forced to alter their business practices due to several issues facing the banking industry, including the cost of compliance management, and traditional sources of banking profitability are under pressure from the rising cost of capital, continued low interest rates, declining return on equity, and declining proprietary trading. Shareholder expectations are unaffected by this at this point. So to retain profitability, many institutions have been forced to develop fresh, competitive service offers, rationalize business segments, and look for long-term improvements in operating efficiencies. Financial institutions must also be able to pivot when necessary and be built for agility, since failing to react to shifting demands is not an option. Number 5 sees an increased expectation where the changing demographics of banking clients have a big impact on these enhanced expectations, because each new generation has a larger expectation of digital experiences as a result of their increased natural understanding of technology. Think about it. Babies know how to use iPhones and iPads, and their babies. Meanwhile, millennials said they prefer to interact with brands on social media 5 out of 6 times. And that's according to a report that millennials account for 47% of all mobile banking users, which is the highest percentage. Digitalization has been driven by millennials. And based on this growth, banks can predict that Gen Zs and subsequent generations will be even more tech savvy and dedicated to omnichannel banking. So baby boomers and old Gen Xers, on the other hand, place a higher emphasis on interpersonal contacts and favor in-person branch visits, but they are the minority. Number 6 addresses client retention, as customers of financial services need straightforward, understandable user interfaces with personalized, pertinent experiences that are accessible whenever, wherever, and on any device. Although it can be difficult to quantify customer experience, client attrition can be detected, and the concept of customer loyalty is rapidly vanishing. Strong client relationships that begin with getting to know the client and their expectations and continually putting the client first lead to customer loyalty. So recent global research conducted by Accenture Financial Services found that about 33,000 banking customers from 18 different areas that took part in this, 49% of the respondents felt that customer service has an impact on loyalty. And by getting to know their clients and engaging with them effectively, financial institutions can increase engagements that result in higher levels of customer satisfaction and wallet share, as well as consequent decrease in customer churn. Bots are one cutting-edge tool that financial organizations can use to improve customer service. Bots are a cost-effective way to increase customer engagement, and studies show that most customers actually prefer virtual support for solving instant issues. I wasn't included in that study. Now, as the initial point of contact, bots may naturally engage customers and be conversational and contextual, speeding up response times and improving customer satisfaction. Sentiment analysis enables bots to comprehend the context and gather data from interactions by identifying emotional indications. With this information, they can evaluate complex issues with speed and convey them to the appropriate parties for resolution. Some wild and freaky stuff going on. Number 7 includes outdated mobile tech and experiences that every bank and credit union now has its own branded mobile application, but just because a company has a mobile banking strategy doesn't guarantee that it's being used to its fullest potential. So to maintain customer satisfaction, a bank's mobile experience needs to be quick, simple to use, fully featured, think live chat, voice-enabled digital assistants and things like that, secure and frequently updated. So by enabling mobile payment features, some banks have even begun to rethink what a banking app might be by allowing users to use their cell phones as safe digital wallets and send money instantaneously to family and friends. Zelle, Venmo, Cash App. Number 8 sees breaches of security as a huge concern. Security is one of the top concerns facing the banking industry due to several high-profile breaches in recent years, and it is also a top worry for bank and credit union consumers. To protect sensitive consumers, financial institutions must invest in the newest technology-driven security measures such as address verification services, which spot suspicious transactions and attempt to stop fraud. AVS verifies the billing address provided by the card user against the cardholder's billing address on file at the issuing bank. End-to-end encryption is a secure communication technique that shields data from prying eyes while it is sent from one end system or device to another. E2EE encrypts and decrypts private messages using cryptographic keys that are kept at each endpoint to ensure that money is transmitted securely from one account to another or from a client to a store. Banks and credit unions can utilize E2EE to safeguard mobile transactions and other online payments. The increased threat of cyber attacks since hackers successfully stole about $100 million from Bangladesh's central bank in February of 2016, there have been growing concerns about a significant cyber attack on banks in the future. So soon after that, representatives of the Russian central bank said that hackers had stolen more than $31 million, or 2 billion rubles at the time, from the nation's commercial banks and central banks. Federal Reserve Chair Jerome Powell mentioned cybersecurity when asked what he saw as the biggest threat to the financial system in a hearing before the House Financial Services Committee in February of 2020. We are particularly concerned about cyber attacks. I am. I believe we have a terrific game plan for more conventional problems like defaulted loans and similar things like that. And according to Powell, the frontier that really causes concern is the increase in cyber attacks, which is odd that they want to have a push for central bank digital currency, which is more cyber risk related. But we do have to pay attention to how banks are threatened. The Federal Reserve Bank of New York claims that due to the interconnectedness of the banking sector, there is an excellent danger of spillover consequences from cyber attacks. And according to the analysis, 38% of the network may be impacted by a cyber attack on any of the 5 most active U.S. banks. So according to experts, U.S. banks are particularly vulnerable to state-sponsored cyber attacks from nations like North Korea, China, and Russia. Jamil Jaffer, founder and executive director of George Mason University's National Security Institute, testified before the House Financial Services Committee on National Security, International Development, and Monetary Policy during a hearing in June of 2020 that state-sponsored hacking is the biggest threat to our financial sector because of the capacities that they can bring to bear. Tom Kellerman, who served on an Obama administration cybersecurity commission and is currently in charge of VMware's cybersecurity strategy, warned of a sharp increase in cyber attacks on banks and other financial institutions during the 2020 crisis during the same session. So then what are the effects of cyber attacks on bank customers? So suppose customers have diligently protected their information and swiftly notified their bank when monies disappear. Well, in that case, then they should have little need to be concerned about frequent cyber attacks on banks. If a customer notifies the bank of unauthorized withdrawals from their account within 60 days of the transaction showing up on their bank statement, banks are required by U.S. law to reimburse the money. Business accounts, however, may be more vulnerable to losses and have fewer protections. While the Federal Deposit Insurance Corporation, or the FDIC, insures bank accounts and bank deposits up to $250,000 for participating institutions, there's no federal guarantee of banks' viability in the case of a significant cyber attack. So attacks can interfere with critical financial transactions by targeting bank processing systems. And the banking industry's main worry is cybersecurity. Can't blame them. And under federal law, consumers are probably able to get their money back in the event of a cyber attack on their account. But some experts are worried that these mounting attacks could eventually endanger the viability of a central bank.